Ladies and gentlemen, thank you very much for attending Yamaha Corporation Business Results Briefing Session. Let me start the presentation. First, I would like to go over the key points of 2017 results as well as 2018 forecasts. First, 2017 results. Our company has achieved growth both in net sales and profit. All the profit lines in terms of operating income, ordinary income, and net income were record high. As for 2018 forecast, 2018 is the final year of the current midterm plan, so let me explain in comparison with the midterm plan. First, net sales will be slightly short, despite of the fact that significant shortage of Indonesia and RV business, which is mainly the North American ROV business, will be covered by the other businesses. Profitability will reach targets. Financial resilience will reach targets, and moreover, cash will be injected in agile manner for growth investment. Also in 2018, ahead of the next midterm plan, as we prepare ourselves for spread of electric motorcycle commuter, we will be investing actively in new business development and robotics in order to create new values. This page shows 2017 results. The table shows from the left 2016 results, 2017 results, and year-on-year comparison. Net sales was up by 11% year-on-year to 1,670.1 billion yen. Operating income up by 38% year-on-year to 149.8 billion yen. Operating income ratio up by 1.7 points year-on-year to 9.0%. Ordinary income up by 52% year-on-year to 154.8 billion yen. Net income attributable to parent company shareholders up by 61% year-on-year to 101.6 billion yen. As I mentioned earlier, all income lines were record high as well as operating profit ratio. By the way, exchange rates were 112 yen for US dollar, 127 yen for euro, and emerging countries' currencies were 13,400 Indonesia rupee for US dollar and 3.2 Brazil real for US dollar. While each currency stayed relatively stable, many of our businesses achieved growth in net sales and profit, and profitability improvement efforts delivered significant results. On this slide, I would like to explain factors impacting operating income for emerging market motorcycle business and developed markets business separately. First, about emerging markets motorcycle business. Sales growth of high-end models, cost reduction, and structural reform in Brazil resulted in scale and profitability expansion, giving positive impact of 30.7 billion yen and FX impact positive 4.7 billion yen and increase in expenses 7.6 billion yen, and in total, operating income has increased by 27.8 billion yen year-on-year to 73.6 billion yen. As for developed market business, scale and profitability improvement, mainly in marine, IM, and PAS businesses, was 11.4 billion yen. FX impact positive 10.7 billion yen, and expense increase 2.8 billion yen, and impact of unrealized income adjustment in the first half 6 billion yen. As a result, operating income has grown by 13.3 billion yen year-on-year to 76.2 billion yen. As for net income, in addition to the increase in operating income, there was no significant amount in non-operating profit, including FX gain and loss, and as a result, net income has increased from 63.2 billion yen to 101.6 billion yen. Next is the current year 2018 business forecast. Format is the same with the previous slide. First, this year's policy is that as we spend expenses for growth, we would like to maintain profitability in stable manner. Although net sales will be slightly under pressure because of FX impact, net sales forecast is up by 2% year-on-year to 1.7 trillion yen, operating income 150 billion yen, same level with the previous year, with negative FX impact as well as increase in growth investment. Operating income ratio will be down by 0.2 point to 8.8%. Ordinary income 155 billion yen, same level with previous year, and net income will be 103 billion yen, up by 1% year-on-year. FX rate assumptions are 105 yen for US dollars and 130 yen for euro, and for emerging countries' currencies, 13,300 Indonesia rupiah for US dollar and 3.3 Brazil real for US dollar. On this page, I would like to explain factors impacting operating income, again for emerging markets and developed markets separately. First, for emerging markets motorcycle business, scale expansion and profitability improvement in ASEAN region, positive 9.5 billion yen, FX impact negative 1.7 billion yen, expense increase 6.4 billion yen, and in total, operating income is forecasted to grow by 1.4 billion yen year-on-year to 75 billion yen. As for developed markets business, scale and profitability improvement impact of positive 17.2 billion yen, FX impact negative 9.3 billion yen, expense increase 9.1 billion yen, including growth-related expense increase of 6 billion yen, and in total, operating income will go down by 1.2 billion yen year-on-year to 75 billion yen. As I said before, 2018 is the final year of the current midterm plan. On this page, I would like to explain the current progress against the plan. First, the progress on net sales. This graph shows from the left 2015 results, the final year of the previous midterm plan period, and the middle is 2018 midterm targets, and the far right is 2018 full year forecast. Original targets for 3 years were to achieve growth of 127 billion yen in developed market business and 250 billion yen in emerging markets motorcycle business, and with negative FX impact of 14 billion yen, we expected to achieve net sales of 2 trillion yen. On the other hand, looking to 2018 full year forecast, for developed markets business, marine, industrial machinery, and robots are already ahead of plan. But unfortunately, motorcycle and power products, mainly North America ROV business, are behind plan. And we expect a shortage of close to 50 billion yen against the original plan, and the current expected growth will be 80.2 billion yen versus 2015. And in emerging markets motorcycle business, Vietnam, Philippines, and Thailand are growing ahead of plan, but India and Indonesia are behind plan, and total shortage against midterm plan is approximately 100 billion yen, and expected growth will be 155.6 billion yen, and with negative FX impact, full year net sales forecast is 1.7 trillion yen. Next is progress on operating income. Again, the format is the same with net sales. In 3 years, we intended to grow developed market business by 36 billion yen, emerging markets motorcycle business by 26 billion yen, and with negative FX impact, we targeted to achieve 180 billion yen operating income. 2018 full year forecast is 150 billion yen, and for developed market business, similar to net sales, motorcycle and North America ROV will be behind plan, and about half of the original plan, 18 billion yen, will be missed, and expected growth will be 17.9 billion yen. On the other hand, in emerging markets motorcycle business, ASEAN and Brazil are significantly ahead of plan, and we now expect growth of 45.8 billion yen, 20 billion yen higher than the original plan of 26 billion yen. And with negative FX impact, full year operating income forecast is 150 billion yen. As you can see, operating income will basically reach the midterm target. Next, I would like to talk about ROE. Our company positions ROE as one of the critical business measurements in the current midterm plan. This page shows results of ROE as well as 3 elements that constitute ROE. net income ratio, total asset turnover, and equity ratio. Looking at 2017 ROE, first, equity was 622.8 billion yen, 44%, very solid number. Since the denominator increases, that gives downward impact on ROE, but looking at numerators, net income and total asset turnover have improved substantially. As a result, ROE was 17.6%, significant improvement. For 2018, equity will continue to increase to 700 billion yen level, while net income ratio will stay flat and working capital will increase slightly along with sales growth. So total asset turnover will go down slightly to 1.19 times. As a result, ROE is expected to go down slightly to 15.6%. But the original midterm plan is to maintain around 15% ROE. So we are more or less in line with the plan. Next, I would like to talk about cash flow. This page shows business cash flow excluding sales finance. Dark blue, cash in is mainly net income and depreciation cost, and cash out is mainly investment, and if working capital increases, that will be cash out, and if it decreases, that will be cash in. In 2016, as a result of SCM reform effort, we were able to reduce inventory significantly. In addition to that, net income growth resulted in significant positive cash flow for the first time in a long time. Also last year, due to sales growth, working capital or cash out has increased, but net income growth was even greater and positive cash growth was 73.6 billion yen, bigger growth than the previous year. In 2018, generated cash flow will be proactively returned to shareholders. And at the same time, as mentioned at the beginning, the company would like to invest this money for the future growth. Now let's turn to shareholders' return. In the current midterm plan, our company is setting 30% of net income as payout ratio guideline. For fiscal year 2017, annual dividend will be 88 yen per share and payout ratio will be 30.2%. Moreover, 2018 annual dividend is expected to be 90 yen per share, and if that is realized, dividend increase will be achieved in 6 consecutive years. From this page onward, I will explain each business. First, this page shows by business net sales on the left and by business operating income on the right. First, in developed markets motorcycle business, 2017 net sales was 250.4 billion yen. Due to FX impact and profitability improvement effort, operating loss was compressed and profitability was improved. In 2018, partially due to negative FX impact, net sales is expected to stay flat and operating profit is expected to go down. Net sales of emerging markets motorcycle business was 794.8 billion yen, operating income was 73.6 billion yen, significant increase in both net sales and operating income. For 2018, again, we are expecting growth in both net sales and operating income. In marine business, net sales was 323.8 billion yen, operating income 59.5 billion yen. Despite of the impact of unrealized profit in the first half, on full-year basis, we have achieved growth both in net sales and operating income. For 2018, again, we are expecting growth both in net sales and operating income. Next is power products business. As a result of business normalization effort in 2017, net sales was 151.6 billion yen and operating loss was 1.5 billion yen. In 2018, due to FX impact, we are expecting decline in net sales. Now that ROV business is normalized, we expect the level of loss to become smaller. As for other businesses, due to strong sales and profitability improvement of industrial machinery, robot, and PaaS business, net sales was 149.4 billion yen, operating income 22.9 billion yen, again increase both in net sales and operating income. I will explain the details of each business in the following pages. First is ASEAN region of emerging markets motorcycle business. The left graph shows net sales and operating income ratio in 4 ASEAN countries, Vietnam, Indonesia, Thailand, and Philippines, and the right side graph shows sales volume. In Indonesia, sales volume continues to decline slightly, but due to increase in high value-added models and growth of global model import, net sales has turned to positive growth. In Vietnam, Thailand, and Philippines, sales continues to be quite strong, and net sales of 3 countries combined increased from 221.1 billion yen in 2016 to 273 billion yen in 2017. Operating income ratio continued to improve from 8.5% in 2016 to 8.9% in 2017 due to product mix and cost reduction efforts. Looking to the right side graph of sales volume, until 2016, declining impact of Indonesia was rather big, and the entire area was in declining trend, but in 2017, sales volume growth in the other 3 markets was greater than decline of Indonesia, and the overall region turned to positive growth trend. In the past 4 years, platform models and global models, which are highly profitable models with significant cost reduction effect, started to account for a larger percentage of the total, contributing to growth in sales and operating income. We will continue to maintain high profitability with platform models and drive new product launches in order to demonstrate strong presence in each market. Next is developed markets motorcycle business. In 2017, net sales of developed markets motorcycle business increased year-on-year to 250.4 billion yen. Although operating income ratio was negative, profitability was improved. The right side graph shows our retail sales volume and market share of the models 55cc and over in 4 regions. Unfortunately, in 2017, we lost share, but we will strive to launch new product targeting developed markets with strong brand uniqueness and roll out Yamaha-like marketing activities in order to create new demand. I said create new demand, but our company is working on various initiatives with the theme of the growing world of personal mobility in the current midterm plan. This is a product lineup of LMW Leaning Multi-Wheel. Since the launch of Tricity Commuter in 2014, we continued on R&D activities, and in the last year's Tokyo Motor Show, we have presented large-size sports model Naiken, which will be launched in market this year. Not just limited to these 2 models, we will be expanding customer base with new values of LMW. Next is marine business. In 2017, marine business achieved growth in both net sales and operating income. However, due to the remaining impact of unrealized profit adjustment of the first half, operating income ratio was down slightly. In 2018, despite of FX impact, we expect to achieve growth in net sales and operating income and improve operating income ratio. The right side graph shows the trend of larger size outboard motors, which is the background behind this growth trend. This graph shows the sales volume of outboard motors by size in North America and Europe. As you can see, sales of outboard motors of 100 horsepower plus and 200 horsepower plus are growing every year. Recently, following North America, we are seeing a noticeable shift to larger size even in Europe. In the next slide, I will explain the status of system supplier strategy that we set up in the midterm plan. The right side of this page shows business domains of our marine business. We offer large and medium-sized outboard motors for middle to small model craft and outboard motors engine for propulsion units. As for the market shift to larger size outboard motors, in North America, we have been strengthening alliances with boat builders. Also in Europe, Ahead of the recent trend of larger outboard motors, we have acquired an aluminum boat builder Booster in 2016 and an FRP boat builder Yamaha in 2017. Both are top brands in high-end boat category with large-size outboard motors. Through these initiatives, we would like to capture increased volume for large-size outboard motors. Also, from the viewpoint of driving system supplier strategy, we have acquired 2 companies in 2017, a U.S. company, Bennett Marine, who manufactures trim tab for attitude control, and another U.S. company, Creco, who handles fuel tank and sensor for the purpose of fuel management. Going forward, we will continue to expand market scope with further boat builder alliance and system supplier strategy. Next is power products business. In 2017, we have worked on normalizing the business through reducing market inventory of ROV, and as a result, we saw a decline in net sales and operating income, and business was loss-making. Looking at the right side graph, blue shows ROV retail sales volume and white is production volume. In the past 2 years, market inventory has built up, so last year we have reduced production volume all the way down to 11,000 unit level for drastic inventory adjustment. As a result, business was loss-making, but inventory adjustment went smoothly and inventory level was normalized at the end of last year. Going forward, we will drive new product strategy to achieve recovery, which will be explained in the next slide. These are the ROV model lineup that we offer. X-axis indicates wave usage, the right is pure sports, and the left is multipurpose. And Y-axis indicates either personal use or family use. In 2013, we launched Viking, then Viking 6, Wolverine, Pure Sports YXZ1000 RSS. We have been launching these new products every year. And in the second half of the last year, in the recreational segment in the middle, which is the largest volume zone, we have launched this Wolverine X4. We will continue to launch new models using this platform in this largest demand recreational segment in order to expand market scope for recovery. Next is industrial machinery and robot products. With a strong sales of service mounter and industrial robot, net sales has grown in big way and operating income ratio was 23%. The new plant, which started in February last year, is already running at full capacity. In 2018, due to full utilization of the plant and component supply issue, net sales will be almost flat, but nevertheless, we expect growth both in net sales and operating income. The right side chart shows surface mounter total market demand and our market share. The blue bars indicate our market share in 2017, and the dotted lines are our original midterm market share targets. As you can see, in some areas, we have already exceeded our midterm targets. On this chart, top part shows faster speed mounter and bottom shows lower speed mounters. This year, as we refresh high-speed product lineup, we will strive to achieve midterm targets. This page shows the high-speed products and newly launched medical system, Cell Handler. Since New Year started in last month, we have announced Z-Lex and Sigma G5S2, as you can see in the middle, new product offerings in high-speed segment. These are full model changes with improved performance. Through these model changes in high-speed segment, we will continue to improve our competitiveness in the area of auto application, where we are strong, and expand our customer base. Lastly, I would like to talk about PAS, electrically assisted bicycle business. Sales volume of both domestic finished products as well as e-kit for Europe has grown, and in PAS business as well, we achieved sales growth and operating income ratio reached almost 18%. Again, we are seeing strong growth in highly profitable business. We expect continued growth both in net sales and operating income. The right side graph shows the total market size of electrically power-assisted bicycle in Japan and in Europe. As you can see, in 2017, domestic market has grown to reach 600,000 units, and Europe 2 million units level, and both markets are still growing. We will aggressively roll out our business not only in Japan but also in fast-growing overseas markets. This page shows the number of domestic PAS registrations by age. Gray is 2005, light blue is 2015, and dark blue is 2017. For PAS, we have been expanding our customer base by offering various different products depending on customers' life stage and enhancing our product portfolio. Between 2005 and 2015, we saw growth in senior segment, which is the original main segment, but also our products became very popular among mothers with children, and these models grew substantially in the past 10 years. Also, what we call 15 years old demand among high school students upon entering high school grew strongly. Also, between 2015 and 2017, in these 2 years alone, strong growth was seen in all the age segments, and especially 15-year-old demand has almost doubled. Going forward, as we enhance product offerings of road bike, we would like to expand the demand of new customers in 20s, where we do not yet see the growth. That is all for our presentation.